Hey, how's it going there? This is Adam Winnig, one of the co-founders of Blue Edge Financial, and I'm thrilled that you decided to pick up a copy of the Edge Trading Secrets book. I know this is going to be game-changing for your trading career. This book had such an impact on me that we wanted to make this available to everybody. For years, I was trying to figure out how to become a profitable trader, and I had fallen for all of the common retail trader mistakes. I had been trading the way that all retail traders are for the most part taught to trade. And because of that, I'd been getting poor results. And I was frustrated and I was about ready to give up on my trading career. I had bought in so many courses, I'd blown so many accounts, had no results to really show for after all of this time studying and practicing. And it wasn't until I met this gentleman that was a real professional Forex bank trader that handed me a copy of his book and taught me how to leave the herd and how to start thinking like the smart money. And ever since I read this book, everything began to change for me. And I know that this has the potential to do the same thing for you. So I'm so excited for you to read this book that was put together by our partner who goes under an alias name as T.D.C. He was a Forex bank trader as well as he has experience at a retail Forex brokerage as well. So he has interesting insight from both the institutional as well as the retail side of the Forex market. And I know this book is going to blow your mind. It totally changed the way that I thought about the Forex market. I know it's going to do the same for you. Now, one piece of advice, if this is your first time reading or listening to the Edge Trading Secrets book, I would recommend that you listen to this while also having a copy of the book actually open, whether that's the ebook or the physical book, because there's a lot of images and graphs in the book that are talked about, and it'll be a lot easier for you to understand if you can actually see those charts and those graphs of what we're talking about. So I know this is something that you're going to refer back to many times. I've read this book so many times, and every time I learn something new. And I know this is going to make a huge difference in your trading career. So enjoy it, and please let us know what you think of the book. I know that it's going to make a huge difference in your trading career.
Edge Trading Secrets: The Unspoken Laws of a Forex Bank Trader. A perspective from the other side of the retail world. For me, it all began with a question I had when I was working as a Forex dealer at a retail brokerage. Why are the percentages of unprofitable traders so skewed? I mean, so unbelievably high. It just didn't make sense to me that over 99% of traders will experience a net loss in the market. Out of more than 15,000 accounts opened at my broker, there would always only ever be 200 to 300 active accounts at once, with the rest of the accounts being inactive, or, to put it another way, they incurred trading losses margin called. So the survival rate was around 1 to 2%. The common phrase that 95% of retail traders are losers isn't wrong. In fact, if anything, the situation is probably worse, and I can certainly verify the statistics. I was extremely puzzled by this fact. I had heard about this statistic before, from just about everywhere in the trading world. However, it was only when I was actually working at the brokerage that I first became interested in understanding why. I thought, from a common statistical sense, yes, retails are always at a disadvantage because they have to play for spreads, slippage. But even with these elements factored in, the stats should be somewhere around 40% profitable, 60% unprofitable, and not to the extreme of 1 out of 100. Also, smart money, like banks and hedge funds, have to pay the spreads, but they are not on the losing side of the market. So there must be something going on here. And so, I set out on a journey to uncover the answer to this puzzle. T.D.C. Chapter 1: Sentiment Analysis. Sentiment analysis is the finest combination of technical and fundamental perspectives. But what exactly does sentiment analysis do? Sentiment analysis looks at the behaviors and positioning of different market participants. This form of analysis will attempt to answer these questions. How can 99% of retail market participants fail so miserably at trading? More specifically, why is the number so skewed? How can your simple human nature be the source of your trading demise? What do the remaining 1% successful traders do differently? How to use sentiment analysis to improve your trading? And how most forms of technical analysis, news, and discussions are designed to make retail traders fail in the long run. First things first. Please do not consider this as absolute Forex advice. You can find millions of pieces of advice and recommendations out there on the internet. Rather, please consider this ebook as a sharing experience from an FX dealer and bank trader who has been fortunate enough to have been given the opportunity to see things from behind the system and to develop his own view on the financial market. Who will benefit from this book the most? You will benefit the most from the information in this book if you are a trader with 1 to 3 years of experience and is still looking for success. I sincerely hope you can find your aha moment from the material that I am sharing. Also, a trader looking for an edge over the market. Although this book isn't about some exact price action patterns or magic indicators, it is about something that most traders often overlook, but is absolutely critical for your success. If you are still a beginner, I recommend that you take some more time to experience the market for yourself first. Experience both profits and losses, and analyze your trading history. What you did right, and what you did wrong. Only then will you probably be able to look back at your trading history and truly understand and appreciate what I'm about to share with you. What this book is not about. It is not about holy grail systems, fundamental analysis, or any indicator-based trading. You'll get my opinion about these later, and it will probably surprise you. I won't give you a holy grail approach with exact rules either. Instead, I'm going to give you the closest thing there is to a holy grail, in my opinion, the understanding of the market structures and dynamics. What is sentiment analysis about? The behaviors of market participants, specifically the herd and the smart money. How these behaviors manifest themselves on the chart. How to use this theory to position yourself better against the herd and with the smart money. Supporting proof, taken from both an academic view and an FX dealer's view. Yes, I believe that this is the only one with strong statistical support, unlike some pin bar or Ichimoku patterns that often do not have any real statistical evidence behind them. Following sentiment analysis principles is the only true long-term edge that you can obtain. Crowd behaviors manifest themselves in any financial markets, albeit to different degrees, and through any period of history since the time financial markets were first formed. How smart money has understood this and exploited the herd's weakness. Some statistics from a back end of retail FX broker to prove my theory. And finally, this will give you answers to almost any questions in the Forex world, such as, is it true that we should cut losses short and let profits run? If a trader pitches to you about his system, can you recognize it as something worth investing in? Some popular internet trading techniques like supply and demand, grid, martingale, hedging, will they work? My answer is a probable no. Is entry the most important thing in a system? It is always said that psychology is the most important thing, but what are the desired psychological traits? Additionally, once you develop better understandings of sentiment analysis, you can find the solutions to some of the most puzzling questions in the Forex world, such as, can we reverse trading a losing strategy into a winning one? My answer is yes. The stop-loss hunting myth. Is it true? And given your trading history, would you be in a book A or book B of your broker? Lastly, Do not simply take my word for granted. You need to go out into the trading world for yourself and see how the herd behaves firsthand. Equipped with powerful new insights, you will see everything in a new light, and hopefully, you can start making even better trading investment decisions. Successful trading does not depend on a technical pattern. It very much depends on your ability to make decisions against your human nature. In order to do so, the first thing you need to do is understand how and why the market works. With this, you'll have a fantastic foundation to succeed as a trader. This book is not going to posture you or give you some holy grail system, but I guarantee that it will give you a strong foundation and framework for building your own personal holy grail approach that works for you. Requirements: intermediate trading level, and some basic statistical knowledge. Of course, not every trader will understand or fully appreciate the information presented here. However, I do hope that, over time, you can look back and see something valuable for yourself. And some traders won't agree with my viewpoint, which is okay. It's not for everyone. At the end of the day, this book is my own perspective or view of how the market works, and you will naturally have your own view. Sentiment analysis, or SA, is a form of analysis that attempts to understand market participants' behavior and positioning in the market. Sentiment means opinion, or more specifically, how each market participant translates their opinion into positioning. Sentiment analysis is the finest combination of technical and fundamental analysis. Technical perspective. Sentiment analysis looks at the chart and discovers how the market moves in relation to each market participant's sentiment. This approach includes order flow, stop and limit orders, trends, levels, and opening positions. Fundamental perspective. Sentiment analysis looks at the reason the market moves. What are each market's participants' intentions and psychological traits, and how do they affect decision-making? If you are familiar with different types of analysis, SA will have some fundamental aspects similar to volume spread analysis, the Wyckoff method, and how its perspective on the market works. However, I believe that SA is much easier for traders to relate to and understand. The players. Smart money consists of banks and funds, while retail consists of small, uninformed traders. Some of the differences: smart money is much better capitalized, can survive long periods of drawdown. It has a much better view and analysis, computing power, and can see order flow of the retails. It's much more disciplined, understands retail behaviors, and can exploit them by different tactics, and they have much better diversification. While retail has limited capital and is usually overleveraged. Retail is an uninformed crowd, the last receiver in the chain of information. They have psychological weaknesses that always manifest themselves no matter what strategy they use. And as far as diversification, little or none. Chapter 2. Measuring the herd sentiment. There are two sides of the equation. The market is always divided into two types of market participants: the herd and smart money. The herd consists of retail and commercial traders, whose main purpose is to hedge their currency exposure, but do not understand how the market moves, and thus they possess similar psychological traits to the retails. Retails and commercial traders are in a similar position, because they are both uninformed and not on the professional speculative side. On the other hand, smart money, or SM, is the big hand that can direct the market into a specific flow or trend with superior information, discipline, and lower risk. If you are familiar with SA, you will notice the first lesson is always about the COT report, Commitment of Traders, which shows the positioning of the commercials, small traders, and speculative traders, the smart money. By observing these positionings with the higher frequency, in nearly real time, of the retail and the SM, we will expand this point into a more useful analytical tool. How are we going to do this? Well, number one, first we will use a sentiment indicator, which measures the positioning of retails, whether they are in net long or net short position over time. Retail positioning measurement is achieved by retrieving data from the largest retail brokers, FXCM, Oando, eToro, SWFX Sentiment Index, and aggregate statistics site, myfxbook.com. 2. Next, we make a rational assumption that smart money will take the other side of the positioning of these retailers. 3. We observe the change in positioning in relation to price action, trend, and levels. 4. We draw any consistent conclusions about retail's and SM behaviors and positioning. And number 5, the FX market is a decentralized market, so we cannot directly observe all market participants' positioning. We can, however, still observe this indirectly and still continue to very accurately perceive the nature of the market. Again, the other side of the herd's trades is the smart money, who understand the herd's behavior and psychological shortfalls, and will exploit them. We can't see smart money positioning directly, but given this, if the herd is in a long position, the smart money will be in a short position, and vice versa. How to treat order flow. Based on my background as an FX dealer and bank trader, we will be treating orders a little differently from most of the retail world. Normally, when you put an order or position, you have stop loss, SL, and take profit, TP. We treat these orders as follows. A long position will have stop loss as a pending sell stop order and take profit as a pending sell limit order. So, in aggregate order book, SL orders of long positions are the same as normal pending sell stop orders, and TP orders of long positions are the same as normal pending sell limit orders. A short position will have stop loss as a pending buy stop order and take profit as a pending buy limit order. In aggregate order book, SL orders of short positions are the same normal pending buy stop orders, and TP orders of short positions are the same as normal pending buy limit orders. Later, we will look at these orders' positioning to discover trading behaviors of retailers. I employ 2 indicators to observe this. One is myfxbook.com/community/outlook and the Oando long-short position ratios. You can find this at fxtrade.oanda.com/analysis/open-position-ratios. Oanda is one of the largest retail brokerages. Thus, they also offer an excellent view of how retail positions move in relation to price action. FXCM Daily FX SSI, Speculative Sentiment Index. This measures the number of buyers and sellers. Similar to Oanda, FXCM retail data is one of the most complete sources of data we could possibly have on this matter. To access the data twice a day, you may need an FXCM account. www.dailyfx.com/sentiment. If the ratio is greater than 1, then there are more long positions than there are short positions. Thus, the number of buyers, the number of sellers, is greater than 1. If the ratio is less than -1, then there are more short positions than there are long positions. Thus, the number of sellers and the number of buyers is negative. Real-time indicator, MT4. I have translated these ratios into a proprietary indicator for MetaTrader 4, which measures these sentiments in real time. By doing this, we can monitor how the retails behave over time. The sentiment indicator will have my FX book and Owanda data measured in real time, and every 30 minutes, the indicator will record the sentiment data from my FX book and Owanda into a text file, and then plot it on an MT4 chart, so that we can see any interesting connections. You can manually follow this sentiment data along with price actions, and they will show consistent patterns. My FX book. Net retail position equals number of long minus number of short, and displayed as a histogram. The blue histogram means the number of long is greater than the number of short. Thus, retail traders are holding net long positions. An increase in the blue histogram, value increasing, means that the herd is longing new positions and closing their existing short positions. The red histogram means the number of short is greater than the number of long. Thus, retail traders are holding net short positions. An additional decrease in the red histograms, value decreasing, means that the herd is shorting new positions and closing their existing long positions. Owanda. Percentage of long positions is greater than the total number of positions, displayed as a line below. For example, if there are 70% traders long and 30% traders short, then the sentiment would be 70. So if sentiment is greater than 50, then there are more traders longing than there are shorting. If sentiment is less than 50, then there are more traders shorting than are longing. The Owanda interpretation is similar to the My FX book interpretation. If the value is increasing, this means that retails are buying more. The percentage of long positions increases. If the value is falling, this means that retails are selling more. Percentage of long positions decreases. Daily FX SSI. Coding sentiment readings from Daily FX SSI into an observable indicator in MT4 is not technically possible. However, we can still follow it day by day in order to see its according behaviors. I'm going to go ahead and make the following assumptions. The herd is predictable, and therefore, they will act similarly and consistently. Although the sentiment readings are not representative of all retail market participants, they will be an accurate proxy for the aggregate retail positioning. The herd behaviors are universal, and My FX book and Owanda sentiment will accurately reflect this, even though they only capture part of the picture. There are only two sides to the market, the herd and the smart money. If the herd aggregately, as they act similarly together, goes long, then smart money must be the liquidity provider and hold a short position. Thus, if most retailers are long Euro-US dollars, then smart money will be shorting Euro-US dollars. The SM, which understands the herd's behavior and psychological shortfalls, will exploit this. We can't see smart money positioning directly, but with this in mind, if the herd is in long position, then smart money will be in short position and vice versa. Okay, so now that we've got through our definition and assumptions, let's move on to the interesting part. If the histogram is decreasing, meaning net long from a higher value to a lower value, then the herd is selling. And if the histogram is increasing, which means net long from a lower value to a higher value, then the herd is buying. Note: you might be wondering about the meaning of the absolute values of the sentiment for each broker, and about what this implies. However, the absolute values, how many percentages are long or short, are not really important. I found that each broker has some very different values regarding absolute values. This is probably something to do with the market segment for each company. For example, Owanda has the smallest value change, and the sentiment value does not move as much as the Daily FX or My FX values. Owanda value can stay in the range of 50 to 60% long for a long time, whereas the MyFX book value can be much more volatile due to the more short-term nature of traders, automatic, higher-frequency retail trading, while Owanda clients consist of more long-term oriented traders or commercial hedgers. Therefore, the values change more slowly. However, we are only interested in the net change of these values and how they move together to portray the characteristics of the herd. DailyFX recommends using sentiment value to measure the trend. For example, they interpret that if long is greater than short, or if long's percentage increases, this means that the herd is mostly holding long position and that the trend should continue to go down. But I found that this is simply not the case. The sentiment value is like a snapshot of the retail values on market movements and has no predictive value whether the trend will continue or not. If you still want to use it as a contrarian indicator, I recommend using MyFX book, as I found that its value has the most syncing with the shorter time frame, and it is made up of the most diversified segment of retail or losing traders. If you want to use MyFX book as a trend indicator, the conditions are simple. If the long positions are greater than 50%, then the crowd is mostly holding long, so the trend is down. If long positions are less than 50%, then the crowd is mostly holding short, so the trend is up. I recommend that you monitor these values, Owanda, MyFX book, DailyFX, for several days, so you can get a feel for how retail sentiment moves within the price action context. Later on, you will see that these indicator readings show the root of why small retail traders are always on the losing side of the market. This is true in every financial market and in every time frame. Chapter 3. Herd Behaviors. Let's observe the retail sentiment indicator in relation to price action. Again, the upper blue histogram is the retail positioning of MyFX book, and the lower indicator windows are the Owanda sentiment. Generally, you can see that when the price is rising, the number of net long position decreases, and vice versa. When the price is falling, the number of net long position increases. Owanda and MyFX book move very similarly to one another, thus suggesting that the herd acts in a similar manner. When you observe DailyFX SSI closely, can you see any pattern? Pay close attention to the increase and decrease of the sentiment. In 2013, as the trend is up, retails are consistently on the selling side of the market. And whenever the market makes an extreme up move, the retail's net short positions also increase substantially. In the second half of 2014, when GBP/JPY was on a strong uptrend, the number of sellers, the red line, rose strongly with it, and the number of buyers decreased. Similar behaviors are also observable in other pairs. Another observation to note is that when the retails were at their extreme selling position, the market tops often collided, and thus the market tops usually happened when retails were extremely net short. Just look at all the extreme retail open short positions above. This also rings true for the reverse. The market bottoms often happened when retails were at their extreme long position. Look at the AUD retail open long positions below. Yes, you might very well have noticed that this is the same as COT sentiment analysis. You can learn more about COT analysis at www.babypips.com. However, what I discovered from the COT is that the phrase, the commercial and the retail position, when they are extreme, can predict market top or bottom, is simply not correct. When the herd is at their extreme position, that does not mean that the market is going to reverse. It only shows that the herd is always going to keep buying when the price is falling, until they're right. Many traders attempt to find the tops and bottoms with extreme sentiment readings. This is wrong because extreme sentiment readings do not have predictive power for market tops and bottoms. They are simply the consequences of crowd behaviors. The basic rule is this: every market, top or bottom, is accompanied by a sentiment extreme, but not every sentiment extreme result is a market top or bottom. Similar tops and bottoms from Oanda and my FX book, The Red Line. The tops and bottoms collide with extreme net long or net short from retails. The most important observation of sentiment analysis is, if the price is going down, then the net position of retails will always increase on the side of longing. The herd will always sell into a price-up move. If the price is going up, then the net position of retails will always increase on the side of shorting. The herd will always buy into a price-down move. Why does this happen? I can offer some fundamental explanations as to why retail sentiment behaves like it does. If the price is going up, then the net long position of retail decreasing, more selling, will be the result of behavior 1, traders subconsciously thinking that the price is too expensive and then putting a new sell position into the up move. Behavior 2, existing traders who are holding short positions, since the market is going against them, average in losers, sell more, and they can get out at break even or achieve a small profit. These traders include grid traders and martingale traders. Behavior 3. Traders who are holding long positions that are in profit will take small profits as the price goes up, thus reducing the number of open long positions. Behavior 4. Traders who are holding short positions below market price, effectively in negative P&L, refuse to put stop loss, move stop loss, or to cancel stop loss as prices go up. This stop loss will be the buy stop orders above the current price, thus creating an imbalance between the buy stop and sell limit order. Both types of orders are above current market price. The number of sell limit orders, the take profit, will dominate the buy stop orders, and thus there will always be more retail pending sell orders than there are retail pending buy orders. Once the price goes up, take a short profit. And behavior 5. If there is a balance of long traders and short traders at one price, due to the characteristics that retails would prefer to take profit short and let the loss run, then over time, in an up move, the number of open short positions will increase, hold on to losses, while the number of open long positions will decrease, close profit short. If the price is going down, then the net long position of retail increasing, buying into a down move, will be the result of behavior 1. Traders think that the price is too cheap and put a new buy position into the down move. Behavior 2. Existing traders who are holding long positions since the market is going against them average in losers, buy more in hopes that the price will retrace and they can get out at a small profit. This behavior includes grid traders and martingale traders. Behavior 3. Traders who are holding short positions that are in profit take small profits as prices go down, and so the number of open short positions decreases. Behavior 4. The traders holding long positions above market price, effectively in negative P&L, refuse to put stop loss, move stop loss, or cancel stop loss as the price goes down. This stop loss will be the sell stop orders above the current price, thus creating an imbalance between the sell stop and buy limit orders. Both types of orders are below the current market price. The numbers of buy limit orders will dominate to sell stop orders, and so there will always be more retail pending buy orders than there are retail pending sell orders once the price goes down. And behavior 5. If there is a balance of long traders and short traders at one price, due to the characteristics that retails would prefer to take profits short and let the loss run, then over time, in a down move, the number of long positions will increase, hold on to losses, while the number of short positions decrease, take profits short. If you see yourself doing the above things, then you are probably on the side of the herd. So, congratulations! You are standing at the first step of changing your trading for the better. What does this really mean? Human nature and emotional trading are hardwired into the herd personality. No matter what strategies or trading systems they use, these behaviors will manifest themselves so commonly that retail traders begin to act the same way across multiple time frames and financial assets, creating behavioral patterns that are both predictable and exploitable. The herd will always sell into an uptrend and buy into a downtrend. The herd positioning is almost always counter-trend trading. To make money in trading, you must consistently be in net long position when the market is going up and be in net short position when the market is going down. Retails lose because their behaviors lead them to be in net short when the market goes up and in the net long when the market goes down, regardless of any indicators or strategies they might be using. If a trader is still following these losing behaviors, then systems, strategies, are the absolute least important factor they should be looking at. When the herd is aggressively making counter-trend positions, they will always be wrong until they are right. They simply do not accept that they're in the wrong position until the market tops or bottoms happen. And when the trend reverses at these extreme tops or bottoms, the herd will be right, but only shortly, until they are wrong once again. Now I hope you can see part of the reason why the herd is losing. In a persistent trend, the herd positioning will be wrong, net short in an uptrend and net long in a downtrend. Therefore, their losses are absolutely huge, until they reach the psychological relax at the top or bottom. When the price is at the tops and bottoms and starts reversing, then their psychology will, again, make them take small profits and let their losses run. Thus, they will reverse their position too quickly and will end up on the wrong side again. On the other hand, the smart money will lose money as the market reverses and will make the most money as the trend persists. In conclusion, as to the question, what psychological traits of retail causes the above behaviors, there are two main reasons. 1. They always have an urge to catch tops and bottoms, behaviors 1 and 2, or 2. They hold on to large losses while taking small profits, behaviors 3, 4, and 5. Chapter 4. Don't follow the herd. So what are the reasons for the above behaviors? Well, you might have heard before that the human mind is not adequately equipped for trading, and this is correct. The human mind has limits and biases, which the SM understands and can take advantage of. Why and how are these behaviors detrimental to trading? Well, in a later chapter, we're going to answer that very question. These behaviors are universal. I had the privilege of confirming the customer data on a smaller scale from the broker where I worked as a dealer. Here's the sentiment measurement for my FX book, Owanda, and Daily FX. Refer to the Chapter 4 charts, available at www.bleedingedgefinancial.com. Here's the sentiment measurement from my FX book, Owanda, and Daily FX. Do you see a similar pattern? As an exercise, you can check these statistics in real time, at any time, and I found that these findings are very consistent. I believe these similarities in the stats do not lie. For obvious reasons, of course, we cannot observe every retail trader's positioning in the market, but this is not important. The point is that we know the herd will always act similarly and predictably, and will be easily influenced into falling into their psychological trap. I have confirmation of the same pattern on a smaller scale from the MT4 Manager, MT4 backend software to monitor clients' trades, during my time working at the broker. Although, since this is confidential data, I cannot give out specifics. Comparing real-time sentiment data to a more traditional form of sentiment analysis, which is the commitment of traders, or COT. The sentiment reader I provided here has the same nature as the COT. The sentiment reader will read the sentiment of the retail traders at a much higher frequency, thus providing much more real-time insight. The commercial positioning in COT will move very similarly to the retail positioning, due to the fact that they possess similar characteristics. They are the uninformed group. The commercial will also sell into an up move and buy into a down move. The speculative positions will be with the smart money and provide liquidity for the commercial, and therefore they will buy into an up move and sell into a down move. Now, let's take a closer look at the herd's behaviors. Retails always want to catch tops and bottoms, behaviors 1 and 2. Refer to www.1.owanda.com Forex-trading. It now seems that to see these order books, they require the user to have a live account with Owanda. Go to Owanda order books and observe any pairs. What do you see? Red-orange represents the net pending sell orders, and green represents the net pending buy orders. There are almost always going to be more pending sell orders, sell limit, above the current market price than there are pending buy orders above the market price, buy stop. There are almost always going to be more pending buy orders, buy limit, below the current market price than there are pending sell orders below the market price, sell stop. Thus, you can mainly see the sell orders above market price and buy orders below market price. What does this mean? Well, this means that the herd has a tendency to catch the tops and bottoms. They perceive that when the price is rising, the asset is getting expensive, and they subconsciously want to sell the top. And when the price is falling, they think it's cheap and want to long at the bottom, thus always catching the falling knife. To look at this differently, the herd's positioning is always trying to play the range or sideway market, thinking that the market is priced within a consolidation range, although, to be fair, most of the time, they will make money, as the market ranges most of the time. Euro-US dollar retail positioning. If you take a snapshot of the retail pending order positioning at any moment, it will almost always look like this. This represents the net orders, or long-short. Open orders. Pending orders. The left picture shows net open orders, long-short. You can see a universal pattern here. At any moment, above the current market price, there will always be more pending sell limit orders than there are buy stop orders. From price 122.11, the current market price, as the price moves up, the crowd will perceive it as getting more expensive. Thus, they are waiting to sell more, either entering a new sell position or liquidating their long profitable positions quickly. This shows us that the crowd is mainly interested in catching the top of the upward move. And the reverse is true from the downside. The crowd will mostly be prepared to have new long into a down move below 122.11 with buy limit orders. This aggregate behavior is the source of why retails will mostly be on the wrong side of the market, trade against the dominant trend. They hold on to large losses while taking small profits. Behaviors 3, 4, and 5. Open positions. Floating positions. The right picture shows exactly the opposite. Retails are likely to hold net long position above the current market price and to hold a net short position below market price. This implies that retails are holding negative floating losses as they leave long position open above market price and short position below market price. Let's suppose that the price is going up. The number of short positions below market price will increase, as retails are known to leave their losses open. Additionally, the number of long positions above market price will decrease, as they cut their profits short. Aggregately, this all leads to total net short position increases when the price goes up. And of course, the vice versa is true. The net long position increase when the price goes down. Again, these patterns are all universal in the Forex market, as well as in any financial market. You can see them in all observable pairs. My FX Book Average Position Price. www.myfxbook.com/community/outlook. Now, if you compare the average short price of retail traders, average long price to the current market price, you can see that the distance from current price to both average long and short prices can be found mostly on the red. Both aggregate long and short positions are deeply negative. Also, if the price is in a strong up move, then there will be some retails that are able to jump long on this move. Therefore, they are holding positive floating PL, albeit temporarily. For example, US dollar to Japanese yen, Great British pound to Japanese yen, and US dollar to Canadian dollar. However, the short floating position of other traders will be mostly in deep loss, so the average short price is substantially worse than the average long price. You can check the pattern by seeing that the red number, distance from price, is always bigger than the green number, since the floating loss is always larger than the floating gain. Also, it is not uncommon for both the short distance and long distance from current price to be red numbers, indicating that both long positions and short positions of retails are in a floating loss. The bottom line. Retails will always hold on to losses while cutting their profit short. Above the current market price, retail will hold a net long position, which means the number of long positions is greater than the number of short positions. As a result, retails are holding negative floating buy positions. Below the current market price, the retail will hold net short positions, which means the number of short positions is greater than the number of long positions. As a result, retails are holding negative floating sell positions. If you ask any retail broker about their floating PL of their clients' aggregate positions, it will always be a negative number, meaning they have negative floating loss. Aggregately, retails will always hold a negative floating PL, and you already know the reason for this. Retail likes to close positive realized trades and then let unrealized losses run, so that, hopefully, their trades will come back. The market will likely return most of the time when the retails are holding on to loss so that they can get out at break-even or a small profit. The high probability of comeback trades will reinforce this tendency to hold on to loss. However, it may be only a small probability, maybe 10%. But when the market does not come back, this is enough to wipe out the retail accounts with a huge move, 500 to 1,000 pip loss. And as small retails are mostly undercapitalized, they will be stopped out. Again, to make consistent money in trading, a trader must consistently be net long in market up moves and net short in market down moves. Retails are always doing the exact opposite. The thing is, if the market follows a probability distribution which supports mean reversion strategies, the retails will make money. Unfortunately, it doesn't, and it will be the source of doom for the herd. Market distribution will be further explained in Chapter 7. Chapter 5. Market Phases. Making money in the market heavily depends on how much of a long position you are holding when the market is rising, and how much of a short position you are holding when the market is falling. Retails are doing the opposite. They are constantly holding short positions when the market is rising and long positions when the market is falling. On the other hand, smart money, such as banks, must find a way to build their large position without causing the price to go against them too much. Thus, they must divide their position and buy multiple smaller amounts in an up move, as retails are trying to catch the top and continue selling to the smart money. As a result, smart money will always be holding a net long when the market is rising and a net short when the market is falling. Besides this, they can afford to take much bigger stop losses, and they understand that following the big move is the only way for them to make money with their huge trade size. I believe this principle applies to every financial market where there is big money and small money trading against one another. Market trending phase. Imagine that the market is very bullish until the market reaches the extreme top. As the market is bullish for some time, retails are selling into this up move. After a 1,000 pip move and price has reached an extreme top, retails will be holding an extreme net short, and smart money will be holding an extreme net long. Now, the distribution process will take place. Retails who have successfully caught the top will liquidate their position soon as well. Therefore, when the price retraces from the top, they will be buying back and will gain a realized profit of 100 to 200 pip move, probably less. The smart money, as their liquidity provider, must sell to them and begin to accumulate short positions from the top. As the uptrend starts to reverse, smart money will go through the process of changing from net long to net short position pretty quickly, as retails buy into a down move. In this phase, the smart money accepts small realized losses as they are the trend follower, whereas the retails capture a small amount of profits as the trend reverses. For the smart money, due to their large position, this trend reversal move will be the cost of distribution when they want to change from a net long to a net short bias. This is the cost for liquidity at a better average price. However, as the price begins moving down, retails who have already bought will now start to be in a negative floating P&L. Smart money will begin experiencing positive floating P&L and will keep scaling more sell positions into the downtrend. As the downward trend persists, the trend will happen for longer than the retails can remain solvent. Retails with a shallow pocket will get stopped out with heavy losses. However, they will never learn their lesson, staying true to their nature, and they will keep buying into the down move until the price bottoms out, or until they think it has already bottomed out. Eventually, they will be correct when the price reaches the bottom and starts reversing. But they will be correct with a small profit and big losses, while smart money receives a handsome reward with a small risk. This process will go on indefinitely, transferring the herd's capital to smart money's capital. Market sideway, range, phase. When the market is in a sideways condition, retails will still sell into an up move and buy into a down move. However, retails will aggregately make money, as their capital, although limited, will survive the sideways market, since the market does not have extreme moves that will stop out the retail. Ultimately, their psychology translates into their style of trading, taking small realized profits and holding on to large unrealized losses, and is fitted to this market condition. The realized profits have a very high chance of success, as the price stays in a small range while the unrealized loss never becomes too extreme, so it can stop out the retail trader. Retails will make many small realized profits within this market condition. However, their style of trading always implies a heavy tail risk that, when it happens, an extreme breakout move, trending market, will wipe out all their small gains and remaining capital. The implications. 1. The herd will be correct at predicting market turns, tops and bottoms. In essence, to put it more precisely, they will always sell into the new tops or keep buying into the new bottoms until they are right. 2. The herd will make small money in a sideways market, and it will lose big in a trending market. Due to their psychological shortfalls, the herd will trade systems with small TP and very large SL, or no SL at all. So this is an extremely unfavorable reward-to-risk ratio. This trading system type is good for trading in a sideways market, as they have some capital cushion until the trade moves into their favor, and they can close with a small profit. When the market has an outburst trend, any losing position they hold will turn into large losses, and retails will get stopped out due to their limited capital. Broker fact. Consequently, the market maker, bucket shops, B-book brokers who trade against their clients, will lose money to traders when the market is in a sideways mode, and will make money, once traders get stopped out, when the market is trending. My broker's P&L pattern will look something like this. 2 to 7. Broker's P&L equals negative 50,000 market sideways. Client's P&L realized is positive, equals 60,000. Unrealized, negative 10,000. 3 over 7. P&L equals negative 30,000. Market continues to move sideways. Client's P&L realized at 45,000. Unrealized, negative 15,000. 9 over 7. P&L equals negative 40,000. Market continues to move sideways. Client's P&L realized at 55,000. Unrealized, negative 15,000. So the retails make money and the bucket shop loses, as long as the market is in a sideways mode. Then, 10 over 7, P&L equals 400,000. Market bursts out in a strong up move. The client's PL realized 50,000. Unrealized, negative 450,000. 11 over 7, P&L equals 650,000. Market continues to go up. The clients are getting stopped out. The client's PL unrealized, negative 600,000. Unrealized, negative 50,000. I hope that you now understand how B-book brokers make money. Unlike retail traders, they are in the market to play the long game, and they have a lot of practice and capital to wait until retail traders have been stopped out. In nature, they are on the same side as hedge funds and banks. Trading against the retail traders. Thus, B-book brokers are trend traders by nature. Lose small amounts of money on a sideways market most of the time, but win back much larger amounts of money in a trending market in a short amount of time. 3. Generally, the herd will always use mean reversion systems, counter trend, while smart money will always use trend following, momentum. Aside from the brainless martingale and grid trading, there are two main types of systems in the trading world: momentum and mean reversion. Or we can also call them by different names: trend following and trend system. Momentum is marked by profit in trending markets, with a loss in sideways markets. They have a low winning percentage, a limited risk, they get out when the price reverses, unlimited reward because they stay in the trend for as long as the trend persists, and lose most of the time, but will make up big because of levy flight moves. And they're used by smart money, as they are the liquidity provider to the herd. Mean reversion, on the other hand, shows profiting in sideways markets and loss in trending markets. They have a high winning percentage, unlimited risk, and no predefined cut-loss point, limited reward. They take profit when the price returns to the mean. They win most of the time, but will lose big because of levy flight moves, and due to their psychology, the herd will always use the mean reversion system. As a bonus, you can check out an article about the commitment of traders, or COT, and the positioning of market players at www.fxstreet.com. Chapter 6. The market is designed to take your hard-earned money. Market manipulations. Why does the market have to work this way? Smart money, due to their nature, must trade extremely large positions compared to the herd, and as a result, they won't be able to enter or exit their positions as easily as small traders can. Imagine being an SM bank trader and having to long 500 million euro US dollars at a good price, and having to find liquidity from the herd, who will sell in many small trade blocks. The only cost-effective option for them is to scale in their positions in a trend to make profit and reduce the possibility of pushing the price against them. To do so, the herd must be induced to sell to SM in many small blocks in a small range, so that the smart money can accumulate a large position at a desired price level. To make the retail do this, SM must manipulate the market, not by their size, but by influencing the herd's psychological bias. Smart money manipulates the herd to try to catch tops and bottoms. 1. Buy low, sell high. How many times have you heard this phrase? I bet it's stuck in your mind for so long that you always try and find a system with the best entry possible. We as humans always want to get a good deal, and to be able to buy cheap and sell high. When you look at the chart, however, you think it's a good deal when the price is at a low point, bottom of your trading screen, and feel the urge to buy, because the price can't fall any further down, can it? Or you feel the need to sell your 100 pip profit trade when the market has already gone up 500 pip. 2. Support resistance. I'm not going to say that support resistance is useless in trading. In fact, these are extremely valuable tools, but only when you can use them in the right way. What I often see in the retail world is that whenever a price approaches a significant support resistance level, people will automatically think that they're going to hold, without taking time to consider the bigger picture. So, more often than not, this behavior is universal. Retail will accumulate long positions into an obvious support, and short positions into an obvious resistance. And that's very predictable, because retail traders are taught similarly. I once entered into an online trading room full of traders. The euro US dollar was going in an upwards move from 1.05 to 1.1. Then 1.1 was an obvious level of resistance with visible peaks and troughs at 1.1. But all I saw in the trading room that day was that people wanted to short, find an entry around the obvious level of resistance. And people found it very easy to agree that this was a great level to sell, no one wanted to buy, even though the price was on a strong move up. From there, I realized that yes, the crowd moves together, and in a very predictable way. You should try that out for yourself too. Just go into any trading room or forum and notice how similar people are always trying to sell in an up move and buy in a down move. You'll be pleased to discover that you're no longer a part of that crowd. Similarly, Gartley patterns, Fibonacci levels, pivot, etc., will encourage retails to try and catch the reversal of the move, tops and bottoms, at an aggregate level in their subconscious minds. Here is a MyFX book sentiment chart of Great British Pounds, Japanese Yen. Great British Pounds to Japanese Yen was in a downtrend for several weeks. The crowd was heavily long into every support level that they could possibly find. And the result? They got stopped out in a violent down move. Net long positions were cut heavily. These were stop-loss orders of the crowd being hit. And what did they do when the price stabilized at a new, lower level? They bought more, waiting for their stop losses to be easily triggered if the trend continued. 3. Overbought, oversold indicators. Even more dangerous than support and resistance, a trend in a strong form will generate multiple overbought and oversold signals as confirmation for traders to think that the move has ended and that a retracement reversal is coming. 4. The media maniac that uses extreme words. You, as a retail trader, must understand that you will always be the last one in the information chain. If the smart money wants to accumulate large, long, or short positions, they will never want to let you know that. So by the time you even have this information, it's already too late, or it's already being manipulated. The media knows how to manipulate your mind by using strong words. They are so skilled at this that you won't notice it, and you'll still think that you are reading the facts. Some headlines like, "The euro has gone to the lowest point in the last 2 years," will subconsciously influence you to try to catch the bottom. The media has a bad track record of predicting the subsequent move. Again, since they belong to the last group to receive relevant information, retails will only be there to fill the liquidity when the smart money has already positioned itself in the market. For example, in an extreme up move, the media will be overly bullish about the asset, sending you the message that this is a good buy. But it's already too late, because the price has now moved by quite a bit. Also, the SM will make you the last one to buy before the market reverses and collapses. If you hear that everyone around you, even a grocery seller, is trying to buy the market, then the top has probably been formed, and now is a good time to sell, since there is no one left to buy. And the SM has to start selling their long position to the uninformed crowd. Alternatively, the media will say that the market is overly extended or in a bubble and will collapse soon, which will serve to spread fear and make the retail sell into the continuing up move, thus fueling more liquidity for the uptrend to continue. You can read more about media manipulation in the book Sentiment in the Forex Market by Jamie Seattle. It's highly recommended. Number 5. Any popular method such as supply and demand. Many people won't agree with me on this. I found this method to be extremely popular in online forums. I think they're successful in making people try to catch the tops and bottoms. Just look at how much pending sell limit is at the supply zone and how much pending buy limit is at their demand zone. From my viewpoint, whichever method is too common or mainstream is probably going to be liquidity prey for the smart money. The only technical tool that doesn't induce retails into selling the top, buying the bottom, might very well be moving average as a trend filter, the herd's psychology bias, to make them hold onto losses while taking small profits. 1. A high percentage winning systems entry focused. Most retail traders are looking for what they call high probability trading systems, which translates in their mind to the system that has over 50% chance of winning. Check out any forums, and you will find these types of statements very often. I am looking for a system with a high percentage win of at least 80%. I have a great entry strategy that wins more than 90% of the time. My trades are high probability trades, which make money in 7 out of 10 trades. These claims or threads are highly attractive to retail traders, but little do they know that this will be the start of their doom in the financial market. Most of the time, to build such a high percentage win system, it will employ such an unfavorable reward-to-risk ratio that it will be the source of absolutely destroying the retail's account. The only way to create a high percentage winning strategy is going to involve a high-tailed distribution risk that is statistically impossible to evaluate. Also, once that 10% probability of losing happens, your small winnings and account will blow up. A little tip: never employ an extremely high percentage system. This carries the same risk as martingale or grid trading: limited reward, but unlimited risk. Just because the tail risk hasn't happened in backtest or in live trading yet doesn't mean that it won't happen at all. And it will happen if there is no longer protection against the tail risk. I personally think that smart money encourages this mindset to expand through the trading world because they know that the retail will make it wrong. 2. Inability to assess probability correctly. I remember reading some discussions in the book Fooled by Randomness by Nassim Nicholas Taleb, in which the author was asked to offer hedge fund managers whether the market would go up or down. Taleb said that he thought the market would possibly go up, but he was in a short position. The managers were puzzled by this and could not understand. Taleb said that the probability of the market going up was indeed high, but he also stated that in the low probability of a market fall, it would be an extreme move that would skew his risk-reward in his favor. The point is that human nature in trading is keen to assess the probability of whether something will happen but fails to assess the magnitude of the event. Therefore, they often mistake high probability trading with positive expectancy strategy. In their mind and psychological comfort zone, a good system is a system with a high winning percentage, even though the expectancy of the system is negative, thus losing in the long run. Given 2 choices, a system wins 90% of the time. Take profit 10 pip, stop loss 150 pip. A system wins 10% of the time. Take profit 150 pip, stop loss 10 pip. 2. The herds will likely pay attention to just the first sentence and completely ignore the last sentence. Thus, they will choose a psychologically comfortable 90% win rate system. The smart money, however, understands long-term positive expectancy and will employ the second system. They accept losing 9 times in a row in order to win big one time. In fact, this is true for most great traders. Most of their profit is attributed to a mere handful amount of their trades, while their losses are a common part of their trading. Small losses, not the big ones. The herd is able to assess the probability of something happening, but they ultimately fail to assess the magnitude of the move when it happens. 3. Avoiding pains and seeking pleasure, prospect theory, cognitive bias. I am not a psychologist, so I will just quote this article from DailyFX. You can find it at dailyfx.com. Why do major currency moves bring about increased trader losses? To discover the answer to this question, the DailyFX research team has looked through over 40 million real trades placed via parent company FXCM's trading platforms. In this article, we look at the absolute biggest mistake Forex traders tend to make, and then look at a way to trade appropriately. Why does the average Forex trader lose money? You should know that the average Forex trader definitely loses money, which is, in itself, a very discouraging fact. But why? Put simply, human psychology makes trading difficult. We looked at over 43 million real trades placed on FXCM's trading servers from the second quarter of 2014 to the first quarter of 2015, and we came to some very interesting conclusions. The first one is encouraging. Traders do make money most of the time, as over 50% of trades are closed out at a gain. The downloadable chart from blueedgefinancial.com shows the results from over 43 million trades conducted by FXCM clients worldwide from the second quarter of 2014 through the first quarter of 2015 across the 15 most popular currency pairs. The blue bar shows the percentage of trades that ended with a profit for the client, and the red bar shows the percentage of trades that ended in a loss. For example, the euro saw an impressive 61% of all trades closed out at a gain. And indeed, every single one of these instruments saw the majority of traders turning a profit for more than 50% of the time. If traders were right more than half of the time, why did most lose money? Average profit-loss per winning and losing trades per currency pair. The chart says it all. The blue bars indicate the average number of pips that traders earned on profitable trades, and the red bars show the average number of pips that were lost in losing trades. We can now clearly begin to see why traders lose money, despite being right more than half the time. They lose more money on their losing trades than they make on their winning trades. Let's use the euro-US dollar as an example. We see that euro-US dollar trades were closed out at a profit of 61%, but the average losing trade was worth 83 pips, while the average winner was only 48 pips. Traders were correct more than half the time, but they lost over 70% more on their losing trades than they won on their winning trades. And the track record for the Great British Pound to the US dollar pair was even worse. Traders captured profits on 59% of all Great British Pound US dollar trades, but overall, they still lost money, as they turned an average of 43 pip profit on each winner and lost 83 pips on losing trades. What gives? Identifying that there is a problem is important in itself, but we also need to understand the reasons behind this, if we're going to find a solution. Cut losses, let profits run. Why is this so difficult to do? In our study, we saw that traders were very good at identifying profitable trading opportunities over 50% of the time, but they would ultimately lose as the average loss far outweighed the gain. Open up nearly any book on trading, and you'll find that the advice is always the same. Cut your losses early and let your profits run. When your trade goes against you, close it out. Take the small loss, and then try again later, if or when appropriate. It's better to take a small loss early than to suffer a big loss later. If a trade is in your favor, let it run. It can often be tempting to close out at a small gain in order to protect profits, but oftentimes we see that patience can result in even greater gains. But if the solution is so simple, then why is the issue so common? The simple answer is human nature. In fact, this is not at all limited to trading either. To further illustrate the point, we can draw on significant findings in psychology. A small wager. Understanding human behavior towards winning and losing. What if I offered you a simple wager on a coin flip? You have two choices. Choice A means you have a 50% chance of winning $1,000 and a 50% chance of winning nothing. Choice B is a flat 450-point gain. Which would you choose? If you look at it over time, it makes sense to take choice A. The expected gain of $500 is greater than the fixed $450. But many studies have shown that most people will consistently choose B. Well, let's flip the wager and run it again. In this case, you can expect to lose less money by going with choice B, but studies have actually shown that the majority of people will pick choice A every single time. Here we see the issue. Most people avoid risk when it comes to taking profits, but then actively seek it if it means avoiding a loss. Why? Well, losses hurt psychologically far more than gains give pleasure, according to the prospect theory. Nobel Prize-winning clinical psychologist Daniel Kahneman based his research on decision-making. His work wasn't on trading, necessarily, but it still has clear implications for trade management and is very relevant to FX trading. His study on prospect theory attempted to model and predict the choices people would make between scenarios that involved known risk and rewards. Kahneman's findings showed something remarkably simple, yet profound. Most people took more pain from losses than they took pleasure from gains. Kahneman explains, social scientists in the 1970s broadly accepted two ideas about human nature. First, people are generally rational, and their thinking is normally sound. Second, emotions such as fear, affection, and hatred explain most of the occasions on which people depart from rationality. He concludes, the concept of loss aversion is certainly the most significant contribution of psychology to behavioral economics. It feels good enough to make $450 versus $500, but accepting a $500 loss hurts too much, and many people out there are willing to gamble on the idea that the trade turns around. From a trading perspective, this doesn't make any sense. $500 lost is equivalent to $500 gained. One is not worth more than the other. So then, why should we act so differently? Prospect theory. Losses typically hurt far more than gains give pleasure. Taking a purely rational approach to markets means treating a 50-point gain as being morally equal to a 50-point loss. Unfortunately, our data on real trader behavior suggests that the majority aren't able to do this. We need to think more systematically to improve our chances at success. Avoid the common pitfall. In theory, avoiding the loss-making problem described is very simple. Gain more in each winning trade than you give back in each losing trade. But how can we do it concretely? When trading, always follow one simple rule. Always seek a bigger reward than the loss you are risking. This is a valuable piece of advice that can be found in almost every trading book and is typically called risk-reward ratio. If you risk losing the same number of pips as you hope to gain, then your risk-reward ratio is 1 to 1, sometimes written 1:1. If you target a profit of 80 pips with a risk of 40 pips, then you have a 2-to-1 risk-reward ratio. If you follow this simple rule, you can be right on the direction of only half of your trades and still make money, because you will be earning more profits on your winning trades than losses on your losing trades. What ratio should you use? Well, it depends on the type of trade you are making. We recommend that you always use a minimum 1-to-1 ratio. That way, if you are right only half of the time, you will at least break even. Certain strategies and trading techniques tend to produce high winning percentages, as we saw with real trader data. If this is the case, it's possible to use a lower risk-reward ratio, such as between 1-to-1 and 2-to-1. For lower probability trading, a higher risk-reward ratio is recommended, such as 2-to-1, 3-to-1, or even 4-to-1. Remember, the higher the risk-reward ratio you choose, the less often you'll need to correctly predict market direction in order to make money by trading. In subsequent installments of this series, we'll definitely discuss different trading techniques in further detail. Stick to your plan. Use stops and limits. Once you have a trading plan in place that uses a proper risk-reward ratio, your next challenge is to stick to the plan. Remember, it is completely natural for humans to want to hold on to losses and take profits early, but that makes for bad trading. We must work to overcome this natural tendency and remove our emotions from trading. The best way to do this is to set up your trade with stop-loss and limit orders from the very beginning. This will allow you to use the proper risk-reward ratio, 1-to-1 or higher, from the outset, and to stick to it. Once you've set these orders in place, don't touch them. One exception, you can move your stop in your favor to lock in profits as the market moves in your favor. You can check out an article and video all about using stops and limits on FXCM's trading station. Managing your risk in this way is part of what many traders call money management. Many of the most successful Forex traders are only right about the market's direction less than half of the time. But since they practice good money management, they cut their losses quickly and let their profits run. They are still profitable in their overall trading. Does using 1-to-1 reward to risk really work? Our data certainly suggests that it does. We use our data on our top 15 currency pairs in order to determine which trader accounts close their average gain at least as large as their average loss, or a minimum reward risk of 1-to-1. Were traders ultimately profitable if they stuck to this rule? Past performance is not indicative of future results, but the results certainly support it. Our data shows that 53% of all accounts that operated on at least a 1-to-1 reward-to-risk ratio turned a net profit in our 12-month sample period, and those who operated under 1-to-1, a mere 17%. Traders who choose to stick to this rule were 3 times more likely to turn a profit over the course of these 12 months. A substantial difference. Does using 1-to-1 reward to risk really work? Absolutely. There's a very good reason why so many traders advocate for it. You can readily see the difference in the chart included at www.blueedgefinancial.com. The 2 lines in the chart show the hypothetical returns from a basic RSI trading strategy on US dollars to CHF using a 60-minute chart. This system was developed to mimic the strategy followed by a very large number of FXCM clients, who tend to be range traders. The blue line shows the raw returns, if we run the system without any stops or limits, and the red line shows the results if we use stops and limits. The improved results are plain to see. Our raw system follows FXCM clients in another way. It has a high win percentage, but still loses more money on losing trades than it gains on winning ones. The raw system's trades are profitable for an impressive 65% of the time during the test period, but it loses an average of $200 on losing trades, while only making an average $121 on winning trades. For our stop and limit settings in this model, we set the stop to a constant 115 pips and the limit to 120 pips, giving us a risk-reward ratio of slightly higher than 1-to-1. Since this is an RSI range trading strategy, a lower risk-reward ratio gives us better results because it is a high probability strategy. 56% of trades in the system were profitable. In comparison, Chapter 7. Tail Risk and Tail Reward. Now you might be wondering, if retails are profiting in sideways markets, smart money is profiting in trending markets. Why is the SM making money while retails are net losers in the end? Assuming the market follows a normal distribution of returns, the overall market results should be as follows, excluding transaction costs. If the sideways conditions happens 80% of the time, the retails have average TP equal to 100 pip. SL equals negative 400 pip. Expectancy equals 0.08 times 100 minus 0.2 to 400 equals 0 pip. If the trending condition happens 20% of the time, the smart money have average TP equals 400 pip, SL equals 100 pip, expectancy equals 0.2 times 400 minus 0.8 times 100 equals 0 pip. The probability should be symmetric and uniformed. However, from my observations working as a retail FX dealer, the retails win most of the time. But when they lose, the loss is often extremely large, so large in fact that it would wipe out all the small profits and margin call their account. This phenomenon is so common that I thought the market distribution wasn't normal. Instead, market distribution of returns must represent a very large tail risk, much larger than normal distribution assumes. Indeed, my theory was correct. The market does not follow a normal distribution, and it is ultimately the dooming answer to retail traders. Tail risk. The probability that an extreme move will happen. The true form of the market is that the financial market follows a levy flight distribution, which is characterized by heavy large tail. What are tails? Tails refer to the end portion of distribution curves, the bell-shaped diagrams that show statistical probabilities for a variety of outcomes. In the case of investing, bell curves plot the likelihood of achieving different investment returns over a specified period. As shown in Figure 1, in a normal bell curve, the most probable returns are concentrated in a bulge near the center, which is the average expected return, or the mean, with less probable, more extreme returns tapering away toward the edges. The tails on the far left and far right represent the least likely, most extreme outcomes. Lowest returns on the left, highest returns on the right. For long-term investors, the ideal portfolio strategy will seek to minimize left tail risk without curtailing right tail growth potential. Tails may be fatter than expected. Traditional portfolio strategies often rely on normal bell curves to make market assumptions, but in reality, markets tend not to behave normally. Periods of financial stress have appeared with more frequency than many investors might think, and on an increasingly global scale. By some estimates, over the past 3 decades, significant market shocks have occurred about every 3 to 5 years, resulting in fatter tails than a normal curve would predict. As shown in the downloadable Figure 2 from BlueEdgeFinancial.com, these unexpected systematic shocks quickly spread panic across markets, creating a downward spiral of declines affecting a broad spectrum of investments. Since they are so widespread and their magnitude so difficult to predict, left tail events can have a devastating impact on portfolio returns and potentially impede your ability to achieve your financial objectives. Those images show how the financial market really moves. It constantly shifts between periods of quiet activities, followed by extreme one-sided movements. Or, to put it in another way, the market is characterized by low probability trending moves and, most of the time, sideways condition. The S&P 500 monthly return chart demonstrates the relationship between stock market returns versus a normal distribution assumption. You can see that many of its returns cannot be explained by normal distribution, specifically the excessive returns that fall outside the tail of normal or Gaussian distribution. What does this mean? Well, levy flight distribution implies that the probability of the market making an extreme move is much higher than normal distribution assumes. In other words, the chance of the market moving in an overextended move is higher than what retail traders expect it to be. To give more clarity here, retails understand that the market must move between sideways and trending motions, but they fail to assess the degree of the move when the market is trending. The probability of an extreme move is much higher than they thought it would be, or the other way around. The 10% trending conditions will result in extremely large moves, and the retails underestimate its risk. According to a levy flight chart, small sideways periods are followed by extreme moves. Typically, retails will make money when the market doesn't experience these extreme moves, but unfortunately, these extreme moves happen more often and at a vast magnitude than retails think. So why are retail traders unaware of this? Well, there are two key reasons. 1. Retails get used to assessing the world by using normal distribution. Almost everything that happens in our daily routines follows a normal distribution, from height and weight to the probability of a car accident. People get used to dealing with randomness by employing the common normal distribution, and as a direct result, they also carry this tendency into trading. And 2, the financial market is emotional, and the amount of traders making emotional decisions will often overvalue or undervalue asset price. In other words, this is the same reason why bubbles and crashes happen, an extreme move motivated by fear and greed. As Nassim Nicholas Taleb suggests in his book, Fooled by Randomness, quote, reality is far more vicious than Russian roulette. First, it delivers the fatal bullet rather infrequently, like a revolver that would have hundreds, even thousands of chambers instead of 6. After a few dozen tries, one forgets about the existence of a bullet under a numbing false sense of security. Second, unlike a well-defined precise game like Russian roulette, where the risks are visible to anyone capable of multiplying and dividing by 6, one does not observe the barrel of reality. One is capable of unwittingly playing Russian roulette and calling it by some alternative, low-risk game. And bullish or bearish are terms used by people who do not engage in practicing uncertainty, like the television commentators, or those who have no experience in handling risk. Alas, investors and businesses are not paid in probabilities. They are paid in dollars. Accordingly, it is not how likely an event is to happen that matters. It is how much is made when it happens that should be the consideration. He continues, what is surprising is not the magnitude of our forecast errors, but our absence of awareness of it. This is all the more worrisome when we engage in deadly conflicts. Wars are fundamentally unpredictable, and we do not know it. Owing to this misunderstanding of the casual change between policy and actions, we can easily trigger black swans thanks to aggressive ignorance, like a child playing with a chemistry set. Essentially, Taleb's opinions about the market are the black swan event, in which the market makes an extreme move, will happen more frequently than most people think it will, and his options trading strategy is based on the levy flight distribution. His preferred method is long option position, betting on the tail reward. And even though it rarely happens, once it does happen, the magnitude of the move will be so extreme, and he would make a lucrative reward with limited downside risk. The article explains more details about levy flight distribution in a great way, as well as how the market moves. You can read it at www.ckarazi.com. Understanding what moves FX prices and how bankers rule. As a trader, the first thing you need to do is understand what makes the price move. In mathematical modeling, the term looks like this. Price action is a random walk with levy flight characteristics. Levy flight is a random walk in which the step lengths have a probability heavy-tailed distribution. In plain English, this simply means that the market goes from slow and random to really fast moves. Traders often try to scalp the market for, say, 5 to 10 pips, and they usually do quite well for a while, and even have lots of winners in a row. Then suddenly, the market takes off and moves 50 pips against them when they are still in their position, and they are left wondering what happened. That's because the market has gone from the random walk to the levy flight in the blink of a moment. The market is random for most of the time, but with pockets of non-randomness. The pockets of non-randomness are very important to understand because that's where the money is. It is mathematically impossible to make money on a random walk market because we are paying the spread. So, on a random walk market, the absolute best case scenario is to lose the spread cost over a large sample size. But the typical human trader loses much faster due to the cognitive flaws that human traders have. The markets actually move in such a way that they exploit human cognitive weaknesses. The market is random most of the time because bulls versus bears, trend versus mean reversion, and a mix of different algo strategies. The cumulative effect of these different players butting heads with different strategies at the same time results in the choppy ranges that you usually see in Forex. Most of the stuff sold to retail traders, such as indicators, Elliott wave, Gartley patterns, oscillators, cycles, etc., are just about as useful as voodoo in the pseudo-random walk that is the reality of price action. So then, what causes the levy flight? The answer relies on the trading activity of the really big banks and hedge funds around the world. You will see 11 banks create more than 80% of the total daily order flow on the market. There is about $5 trillion of order flow per day in the FX market, and only $500 billion come from retail investors, about 10%. Retail order flow is referred to as uninformed flow by the bank guys. Let's look at a hypothetical example of how such a bank guy operates on the FX market. Assume that IBM wants to move euro revenue back to the US and gets a quote from Deutsche Bank. The bank guy sees this big order go onto the order book at that price, say half a yard or 0.5 billion euros. The price will have a small cushion for the bank to execute the transaction. Let's say 40 pips. So the bank trader has two very important pieces of information here that they can use to help push the market into the direction that they favor. One, they've got the quote from this big transaction. And two, they also know the cushion that can give some protection against the downside. Note that euro to US dollar is the most liquid currency pair. At the liquid times of the day, typically in the London and New York sessions, a trader can actually fill a euro US dollar trade ticket for approximately $50 million between 1 pip without any problem. But if I am a bank trader and I want to put $0.5 billion into the market, then other people are going to see this, and that starts moving the price. How much the price moves depends a lot on other factors too. But let's keep it simple for now. The bottom line is that the bank trader needs to get their own positions filled at a good price before they put their big IBM order into the market. A bank trader can look at the charts and know the pattern that the dumb money plays. They can put bids in the market, paint some candles, and run the stops at a good price. Euro US dollar typically moves 120 to 150 pips a day, but it bounces between a 20 pip range most of the time. Then suddenly, the market takes off, and prices start moving very fast. The big guys are getting their positions filled during these quiet times. Here is the example with numbers. Current euro US dollar price, 1.38. Bank quotes IBM, 1.3760, 40 pip cushion. Bank trader puts a bid in the market to buy US dollars at 1.3820. The bank trader knows where the stops are for retail investors. They are usually 10 to 20 pips away from the current price, at round levels like 1.38, 1.382, or 1.385, etc. So they push the market up there and buy US dollars on those levels easily, since those positions are stopped out automatically by retailers. So they push the market up there and buy US dollars on those levels easily, since those positions are stopped out automatically by retailers. When the trader is happy with their position size, they can then let the IBM order rip to the market. This will begin pushing euro US dollar lower, equal or greater than levy flight. And this is where the market goes from quiet, random walk, to big moves. Retailers are looking at 1-minute and 5-minute charts, which are full of biases. And they don't really see the big picture, whereas bank traders typically look at 1-hour, 4-hour, and daily charts, and that is exactly how they are able to operate and make decisions. The bank trader usually likes to run their position to another stop zone to close their trade, since they now have a big euro US dollar position that they have to sell. The reason they sell at the next consolidation zone is because they cannot sell their $500 million US dollar position as quickly as a retail investor can jump in and out of the market, as they have a much bigger position. So let's say that the levy flight takes the price from 1.38 zone to 1.37. The bank position has filled most of it in the 1.382 zone and sold most of it in the 1.37 zone for an aggregate 120 pips gain. If the bank played with the same half-yard position size, then our trader just made 4 to 4.2 million US dollars in profit. The IBM position is a similar case, but less so, since they are using this order to help push the price down. If the price goes against the trader, then they need to get out fast, since the bank has already agreed to the 1.3760 price with IBM for half a yard. But at the same time, this large order will help soak up the price pressure over a short time frame. These sorts of things are the reason why you often see fake-outs and shakeouts in the market, in which stops are run on both sides and then a big move happens. There are also other reasons, such as tip-offs from government traders, etc. For instance, Deutsche Bank has contacts with the European Central Bank, and Goldman Sachs have friends in the Fed, just to name a few. So they have a pretty good idea of the news coming out. So, what is the retail doing wrong? Their psychology makes their trading very susceptible to the tail risk. As they hold on to losses and cut their profit too soon, they are susceptible to the tail risk and fail to capture the tail reward, while the smart money are doing the opposite. They cut the tail risk and embrace tail reward. In hedge fund or bank prop trading, there is a reason why they always have to observe the cent loss cut criteria. The maximum drawdown loss cut, the stop loss for each position, the daily max loss exposure, and the risk management department, all these rules are there to cut off the fat tail risk of the market when it happens. Here is an abstract from The New Market Wizards, Jack D. Schweiger. What are practical implications of the variance not being finite? If the variance is no finite, it means that lurking somewhere out there are more extreme scenarios than you might imagine. Certainly more extreme that would be implied by the assumption that prices conform to a normal distribution, an assumption that underlines most statistical applications. We witnessed one example in the one-day 8,000-point drop in the S&P on October 19, 1987. Normal estimation theory would tell you that a one-day price moves this large might happen a few times in a millennium. Here we saw it happen within a decade of the inauguration of the S&P contract. This example provides a perfect illustration of the fact that if the market prices don't have a finite variance, any classically derived estimate of risk will be significantly understated. The implication. As we know that the extreme moves happen more often than we think, and they are the source of smart money profit and retail's loss, we must employ a trading system that can capture these extreme moves while managing our downside risks of these extremes. Usually, these systems are trend-following, momentum system in nature. Momentum, trend trading versus mean reversion, sideways strategies. An abstract from Fooled by Randomness by Nassim Nicholas Taleb. Quote, momentum strategies are more robust than mean reversion strategies. Mean reverting strategies have natural profit caps. Exit when price has reverted to mean, but no natural stop loss. We should buy more of something if it gets cheaper. So it is very much subject to left tail risk, but cannot take advantage of the unexpected good fortune of the right tail. Very fragile indeed. On the contrary, momentum strategies have natural stop losses, exit when momentum reverses, and no natural profit caps. Keep same position as long as momentum persists. Generally, very anti-fragile. Except, what if during a trading halt, due to the daily overnight cap or circuit breakers, we can't exit a momentum position in time? Well, you can always buy an option to simulate a stop loss. Taleb would certainly approve of that. Chapter 8. Show me the money. Congratulations! You've already come this far in this book, and you are now ready for the practical part. Namely, how to start using this knowledge to enhance your trading performance. The first thing you need to know is that the market moves between different phases, and no trading system will be able to consistently profit in all market conditions. A system designed to perform well in a trending market will fail in a sideways market, and vice versa. With that being said, though, you know that even the SM has its period of losing when the retails are making money, specifically when the trend reverses or the market is sideways. So your objective should not be to look for a holy grail that never loses. Instead, you should be looking for a system that is able to control losses the best when the market is in an unfavorable condition, and that makes great money when the market is in a favorable condition. Or, to put it differently, find a system that has good recoverability after a drawdown. So, what would be the best shot at designing your own holy grail? 1. Given that the market follows levy flight distribution, Only use a system that embraces the tail reward and limits the tail risk. 2. Do not use a system that has limited reward and unlimited risk. For example, martingale, grid trading, hedging, or some mean reversion, sideways system that have extremely wide stop losses. 3. A system that embraces the tail reward and limits the tail risk will have these characteristics. Fixed or controlled stop loss. Uses trailing stop loss. Has favorable reward to risk ratio. For example, 100 pip TP, 50 pip SL. Generally, trend following and breakout systems that follow momentum, reversal, range systems can work, but they are still going against the general market rules. 4. Generally do not employ a mean reversion sideways system. 5. Do not try to catch tops and bottoms. Some people have done this successfully, but it's still a process of swimming against the tide. 6. Cut your losses short and let your profits run. 7. Follow the trend. Trends may manifest in multiple time frames. Regardless of what method and time frame you use to detect the trend, stay consistent with it. 8. Scale in the trend as the smart money does. Keep being net long when the trend is up, and keep being net short when the trend is down. Doing this is going to be very psychologically difficult, but it has the potential to give you huge reward to risk trades. 9. Forge your psychology to employ a system with a low win rate but high reward trades. Systems with high win rates but low risk to reward will have a higher chance of leading to ruin because of the levy flight distribution. Systems that control losses better will have a greater ability to recover, and thus will be more sustainable in the long run. And 10. Understand that your capital is limited and that the market's capital is unlimited. You need to preserve your capital by accepting temporary drawdowns in the short run so that your account can sustain in the long run. What about the entry? Well, my answer is the entry is not very important, or at best, the entry is going to be the least important part of your system. As you may notice, these principles are mostly applicable to the exits. Even if you have a system that has a 95% win rate with near perfect entry, if you mess up the exit, as in let the losses run, then your system is probably going to fail in the long run. The most important parts of a system are risk management, the exit and market condition. You will still have to find a robust entry method, though. You must cut your losses short and let your profit run. This is one of your most reliable edges where most traders get it wrong. During my time working as an FX dealer, I saw retail traders employ entry in a million different ways. Stochastics, MACD, price action, supply-demand, etc. However, as long as they still embrace the tail risk and limit the tail reward, they will be doomed to fail. In fact, I think that entry actually isn't very important at all if a trader has the psychology to hold the winning trade along the prevalent trend. The entry will be much less relevant than the exit. The problem with retail traders is that they care too much about the entry, but they fail on the exit. There is research somewhere that tested a random entry system with a more predefined exit and exploitation of the levy flight, say TP greater than SL, and their portfolio turns in quite consistent yearly profits across all traded assets. Unfortunately, I cannot remember where I originally read that research, but it certainly demonstrated the importance of exits and the relevance of entries. Here is the opinion of Dr. Van K. Tharp, a leading author in trading psychology. There are as many as 10 components to a professional trading system, and the original signal is probably the least important. Van Tharp. Check out www.newtraderu.com. So many traders spend a vast majority of their time on the best entries into trades, when that is not really the most important thing for profitable trading. Here are 10 things for a trader to consider that are more important than their entry price. 1. Entry price is meaningless unless it is a good quantified entry with the odds in favor of it continuing to go in the direction of profitability. 2. Exits are where profits are made, not entries. Profitability will ultimately be determined by your skill with exits, not entries. Trailing spots and price targets are more important than entry levels. 3. The risk-reward profile being in your favor is more important than the entry price. 4. You definitely want to risk a little for an opportunity to make a lot. 5. Your stop loss is more important than your entry, because how much you lose when you're wrong determines your success more than your skill of entry does. 6. Your ability to take all entries that have an edge with discipline is more important than any single entry level. 7. Position sizing will determine whether you can hold a winner or exit a loser with discipline. Big trades will engage your emotions and your ability to trade with a plan. 8. A trading plan will determine your success more than just entry levels. Trades must be made inside a methodology with an edge. A single entry is meaningless outside of a quantified methodology. 9. Your ability to master your risk of ruin as a trader is more important than entries are. So, your first losing streak is not your last losing streak. And 10. The market environment itself trumps any entry signal, and the market itself is what determines whether you win or lose, not you, and not even your system. Finally, some people think that sentiment analysis and contrarian trading mean to go against the crowd and to try and catch the tops and bottoms. However, this is not true, because to be a true contrarian means that you must do the opposite of the retails and have the opposite mindset and psychology when compared to the herd. Remember, the levy flight and the trend are your friends, besides your psychology to cut losses and let profits run. If you follow these principles, you will be swimming with the flow of the river, and it will be much easier than if you were to try and fight it, swimming against the tide. Chapter 9. System Analysis. Why do most retail trading systems fail, and most investors lose money with them? Typical retail trading systems strive for extremely high accuracy trades, normally an 80 to 100% win rate. Yes, a 100% win rate. This high rate of success leads investors to falsely evaluate risks for the strategy, since drawdowns have not happened frequently enough, or the drawdowns have not happened at all in some cases. Therefore, investors assume that these systems are safe and have little or no risk at all. Additionally, system recovery ability cannot possibly be calculated, as these systems have never really recovered from any meaningful drawdown. Remember, just because a system backtest real trading history shows that it hasn't blown up before, doesn't mean that it won't. Look at martingale grid and hedging systems. Most retail systems you find on offer are the result of surveyorship bias in the short run, meaning they are the most likely based on luck, and their risk cannot be evaluated because drawdowns or cutting losses have not happened frequently enough. Systems are sellable when they are eye-catching to investors. And how do system sellers achieve this eye-catching aura? With very high win rates, trying to profit every day, every week, and refusing to cut losses to protect their track records. A high percentage win rate produces a nice balance curve every day, small realized profits, which satisfies the traders and investors' instant gratification for a short-term result. This will reinforce a trader's behavior of holding onto losses to protect their track record, their balance curve, in fact, nicely, and will give investors a false sense of security. The trader is only cheating themselves with an extremely smooth balance curve to assure investors that they are low risk. Investors then have a false sense of security by seeing small wins every day until an unrecoverable loss finally happens. A balance curve does not have any value if equity is at a loss or is unstable, or employ volume manipulation for recovery, such as averaging losers. These issues all lead to the fact that most retail traders' strategies have a terrible reward-to-risk ratio. In fact, we commonly see systems that bet the whole account in order to scalp every small possible gain. These systems consist of a trader lets a small loss turning into big drawdown, thus wiping out multiple month gains, and it is difficult to recover. A trader averages loser, which tie up capital for a long period of time before they're able to get out, if they're lucky. Traders who use mental stop losses. Most of the time, when the loss is large enough, they won't cut their losses because emotions are clouding their logic. Don't trust mental stop losses, a martingale grid hedging system that has limited fixed reward and unlimited risk. Remember, the market remains irrational for longer than we can remain solvent. Even if 1% of trades goes wrong, that can completely destroy your accounts. When a trader digs themselves into a hole with a deep loss, there is no way to get out. All options other than straight-up cutting the loss are not useful. Martingaling, hedging, and averaging existing losing positions are the behaviors which show that a trader does not accept losing trades, and will most likely fail, not counting on the fact that a margin will be held for a long time, and on accumulated commission swap costs. A strategy is only sustainable when higher balance is created as the result of higher equity curve. Strategies with equity constantly below balance show the hidden risks of serious DD. Think about it. If a strategy is unable to make new equity high, then it will not be able to sustainably make new balance high. Most successful traders, such as Richard Dennis and Ed Seykota, actually have a low win rate, less than 50%, but exceptional reward-to-risk trades. Quote, "If you can't take small losses, sooner or later, you will have to take the mother of all losses." End quote. Ed Seykota. If I could just give one simple tip for all traders and investors in the retail FX market, any financial markets that would save them a lot of time and money, it would be this. For investors, if you want to invest into a trading system, strategy, or trader, look at its track record. A strategy is only good when higher balance is achieved as a result of higher equity curve. Any strategy that tries to achieve higher balance without regarding to the equity curve will fail. A strategy that does not have protection against the tail risk, extreme market moves, will fail. This is a statistical fact. As an investor, if you evaluate a system, turn off the balance curve and see whether the equity curve is stable and rising. The reason? The equity curve is the true pricing of all market movement, noise, expected payoff into a trading strategy. Every trading decision of the strategy, entry, SL, TP, trade management, money management, components are reflected into the equity curve. If the curve is stable and rising, then that is the hallmark of a good, robust system, not the balance curve. It means that the trader is making the correct decisions regarding all their trading components. But I bet you will find very few systems with only this one piece of criteria in the retail FX space. Let's look at some examples that you can find on blueedgefinancial.com. It's a nice curve, isn't it? This is a very stable balance curve without any meaningful drawdowns. The numbers look unbelievably good, with profit factor equal to 2.52 and a nearly 80% win rate. This system is attractive to retail investors who have no knowledge on how to evaluate trading strategy. The equity curve is showing some volume manipulation for recovery. In this case, grid trading. This curve is attractive to retail investors because they see it as stable and assume that the risk is low. Also, do you notice how equity is constantly below balance? That's because the trader has only closed realized profit trades and is holding on to unrealized losses. But then, the hidden risk still showed itself in the end. Typical grid martingale balance equity profiles, stable and rising until total crash or unrecoverable drawdowns. This system is a mean reversion system. You can recognize this from looking at its equity balance curve profile. It is a good system with positive expectancy, aka trading edge. However, the curve shows typical stable rising curve with sudden drawdowns, such as black swan events happened, and a long period, several months, to recover from each drawdown. And finally, do you notice how the curve of this system behaves completely oppositely than the first system does? Here, we have long periods of stagnation with sudden bursts of profits. This is the typical curve of a trend-following momentum system. Stays in drawdown 90% of the time when the market is in sideways mode. The system tries to control risks with cutting loss and wait for the big trend. 10% of the time, it makes sudden large profits, which represent the ability to capture levy flight more. Equity is mostly always above balance, showing the trader's ability to let profit runs. Drawdown periods are long, but the drawdowns are shallow, and risk is controlled very well. There is virtually zero chance of blow-up, along with a good chance of continued long-term profitability, as long as the levy flight moves happen. But most investors are not fond of this performance because they see it as having too long of a period of drawdowns and an unstable equity curve. They can't wait for 6 months of no trading profit. They want constant profits every month. They would rather have System 1 instead, a nicer curve and lower risk. Good long-term robust systems are very psychologically difficult to trade due to the unstable short-term balance curve and long drawdown periods. Most retail traders want to profit every week, every month, but the market will only pay premium, alpha, to the traders who have the mental strength to trade difficult, long-term, and robust systems, and will punish traders who try to rob the market little profits every day, every week. The trading edge is not in the system itself, but in the trader's psychology and discipline to trade through months of stagnation with no result, but to still persevere and wait for the big trends, a quality that very few investors actually possess. The reason the crowd has been, and always will, lose at the trading game is that the sheer mental strength required to be a successful trader is higher than they could ever achieve. Finally, here are some quotes from the book Market Wizards and New Market Wizards books by Jack D. Schwager, which truly show that these market wizards understand and utilize sentiment analysis at its finest. Please, don't take my word for it. I can certainly be wrong. Go out and experiment all this for yourself. Reflect on your trading and learn more about statistics and trading system development. take a good look at both successful and failed examples of trading strategies on the internet and study them. They are all there to help you on your journey to become a better trader. I wish you the very best of luck in your trading. Chapter 10. Putting these edge trading secrets to work. By now you're probably thinking about the markets differently than you have in the past. You've likely gotten insight that 99% of retail traders will never get. But information without action is poverty. So, how do you implement these new philosophies and strategies to create life-changing wealth? You're absolutely welcome to implement these strategies into your manual trading strategies, or if you'd prefer to use our already built trading system, we'd love to help you. You'll notice that these systems implement the core concepts taught in this book. For more information about our products and trading systems, please visit www.blueedgefinancial.com. We have live chat support available 24/7 to answer your questions and help you get set up with our trading systems. You'll be able to see FX book results for our different trading systems. Please note that these FX book results are displaying a fixed lot size, meaning it is non-compounding. It is simply trading the same lot size the entire time and not increasing the lot size as the account balance grows. You are more than welcome to use the compounding features that are pre-built into the trading system. You can see a live demo and live reel at www.myfxbook.com/members/EdgeTrader7. You can see a backtest at docs.google.com. If you never use any of our trading systems, I hope that this book was insightful and will help give you a serious edge in your trading. If you are interested in using our trading systems, please visit www.blueedgefinancial.com to get started. You are more than welcome to try our systems for 30 days, and if you're not pleased, we'll give you your money back. No questions asked. With your membership to Blue Edge, you're also going to get a bunch of other cool bonuses to help you with your trading. If you'd like to join our private Edge Traders official Facebook group and spy on our other members' success, you can do so at facebook.com/groups Edge Traders Official. Once again, thanks so much for the opportunity to help you prosper. You have been listening to Edge Trading Secrets, the unspoken laws of a Forex bank trader, how to leave the herd and join the smart money. Written by T.D.C. and Blue Edge Financial. Narrated by Jason Sullivan. Production copyright 2021.